You're watching Metals in Motion. I'm Thalia Hayden with ETF Guide. Great to see you again. Joining us now is Justin Tolman, Senior Portfolio Manager and Economic Geologist at Sprott Asset Management. Welcome, Justin.
Thank you, Thalia. It's nice to be here.
Justin, let's start with the biggest surprise of 2026. We've reached the halfway point of the year. So in your opinion, what has been the single biggest surprise in the metals and mining critical materials space?
I think if I had to put my finger on one thing, we've seen a change where price isn't the dominant driver in a lot of commodities at the moment. It's policy. And for most of my career, metals markets were explained by very straightforward things: geology, grade, cost curves, inventories, prices. If supply is tight, prices rise. If they rise enough, more capital comes in and new supply. And that framework is still in place. But we're seeing a really rapid shift now where it's not enough. Governments are coming in and they're not just acting as the regulator, they're acting as the buyer, they're acting as the financier. They're disrupting the markets, and sometimes they're doing all of those roles at once. We could talk about rare earths, for example. This was a niche market, but suddenly it's exploded into this strategic choke point where it's critical for defense, it's critical for wind turbines, it's critical for robots, semiconductors. And the issue isn't China's market share, it's that China's willing to use it as leverage. So it moves rare earths from commodity prices into a discussion instead about supply chain security almost overnight, certainly in months. But the same logic applies to different commodities globally. We could go to the DRC, which controls the lion's share of the world's cobalt, and last year they moved to place an export ban on it, and this year they've put quotas on cobalt to control that. You could look at Indonesia, which has used export restrictions to force downstream processing. We saw Zimbabwe do something similar for lithium this year. The common thread is that critical minerals aren't just ordinary commodities anymore, they're strategic, and governments are treating them like that. And that adds an extra layer of demand. Governments aren't just buying a metal, they're buying security, redundancy, optionality. The speed at which we've seen that come through, I think, is very important and, would be a surprise to a lot of people.
And when we look at Sprott, what makes it different about anyone else in the space?
I think if you go on our website, the tagline is something like a global leader in precious and critical metals or something like that. And that's good, but I would reframe it as the global leader in the natural resources and metals and mining space. We were doing this back when nobody cared, through the bear markets. It's been in our DNA. I'm a geologist by profession with, decades of industry experience on the other corner of the desk before coming to Sprott. And we bring a lot of rigor and a lot of depth to this. This is our sphere of competence. This is what we get up in the morning and what we think about. The universe of projects, the operators, we know which management teams have a history of under-promising and over-delivering. We know who can build mines on time. We spend a lot of time doing deeper due diligence because we've got the raw technical expertise. We go out, put boots on the ground, look at the projects, engage with the operators. This is our bread and butter. So I think if you're going to talk natural resources, Sprott should be the starting point.
Now, if you had to identify one area within the metals or critical materials complex that's currently underappreciated by investors, what would that be?
In terms of an underappreciated area, most people now probably understand the broad case for things like gold, for things like copper and uranium. The harder and the more interesting opportunity now is being able to filter the universe of projects and companies and find the ones that'll actually be able to take advantage of this beyond just beta to the commodity price. What are the projects and what are the special situations where the market still hasn't fully priced in the value of scarce, long life, high quality assets in the right place? You know, mining equities are a pretty inefficient sector of the market. It's technically complex, it's cyclical, it's capital intensive, it can be volatile. You know, lots of assets can screen cheap at different times. What we're trying to do is work out which of these cheap things are genuinely mispriced, which projects have the combination of factors that will go on and become a successful mine and deliver alpha independent of the commodity price. You know, the resource quality, competent management teams, well-managed balance sheets, those kinds of things. That's where the contrarian sort of opportunities for outperformance sit today.
Now, if there's one big lesson investors should take away from the first half of 2026 regarding critical materials and metals, in your opinion, what would that be?
Well, this is very topical because it's been a rough couple of weeks in metals and mining. And this isn't a new lesson, but I find that life is very generous with me. It keeps giving me the same lesson over and over again till I learn it. And, you know, you can sum it up with the idea that you can have long-term scarcity in a product, but that's not a shield against short-term volatility. It's true in mining, it's probably true in life, but we've seen it again in 2026. You know, your commodity, your stock can have a great long-term thesis, and it can still get sharp drawdowns because of rates, because of energy, because of geopolitics, currency movements, changes in risk in the general markets. You know, let's look at silver, which had a big run up at the start of the year and then a bit of a blow off top, and I think it's down about 50%, you know, of year to date if we look at it today, which sounds horrific until you step back from that volatility, and if we put it on a 3-year time frame, the price is probably up 150%, and, you know, investors should be celebrating, but just doesn't feel like it in the moment, and there's some contrarian value there too. But I mean, look at, we saw lithium do similar things. I mean, it can run up in January and then have these big 20% pullbacks very fast. I've seen that would be a bear market type move, and it happens over a few weeks. We saw that in January, February for lithium carbonate prices. But then you step back again and you realize, well, the price is actually up 30-35% year to date. So I guess what I'd say is it's important not to confuse volatility with a true change in fundamentals. I get some of my best opportunities when the market extrapolates a few weeks of pain into some sort of permanent impairment, and the reverse can also be true. You know, don't believe you're a genius when things skyrocket up again because suddenly people care.
Good insights there. Now, looking forward, as we move into the second half of 2026, what are the key indicators you will be closely watching?
I think it's important into the back half of this year that we pay attention at the interplay between cost inflation and physical market tightness. We're probably going to see the highest costs we'll see all year as the Q2 results start to come through. You know, there's obviously been an impact to power and some consumables being available through Middle East conflicts and some of the fallout from that. But we have to balance that against genuine market tightness. And, to use copper as an example, it's very common cyclically to see producers not be able to meet guidance. Not all of them and not all at once, but it impacts supply. And we've seen material supply go offline at key times. Look at Kamoa-Kakula, El Teniente, Grasberg. It takes that out of the market, and it can really exacerbate very tight concentrate markets, puts pressure on existing deficits, and balancing that against the tightness, we could see a real tension start to come up between higher costs make higher incentive prices, and that in turn means that existing assets that are able to do what they say they'll do and meet their commitments become even more valuable. They're already there. New supply becomes slower to bring online unless there's a good incentive price for it. And companies that are able to navigate through that should be rewarded.
Great perspective, Justin. I think we all learned a lot. Thanks so much for joining us, and we appreciate your timely insights today.
You're most welcome. Thank you, Thalia.
And to get the latest research and dive deeper into Sprott's ETFs tied to today's most in-demand critical materials from uranium to copper and beyond, you can learn more at SprottETFs.com. And if you missed any episodes of Metals in Motion, we've got you covered. Check the description below. Every episode from season 3 neatly organized for you in our playlist, ready to watch. That does it for today's episode of Metals in Motion. If you enjoyed the show, please tell us in that comment section below and hit that like button. I'm Thalia Hayden with ETF Guide. Thanks for watching, and we'll see you next time.